this piece, I want to talk about interest rates. So what's going on in November? Now, the Bank of England have actually maintained interest rates for a second month. Oh, my word, we're in uncharted territory here. Now we're staying at 5.25% for the second month. So I feel we've now really entered a new chapter. We've finished with that phase of increasing rates to put a stop on spending and to get inflation going in the right direction. The Bank of England clearly feel that's really starting to hurt the consumers and certainly do its job, which is why 2/3 of the Monetary Policy Committee this month voted to keep rates the same. Last month it was really on a knife edge, 5 versus 4 to keep rates the same. This month 6-3. So the consensus is clearly to keep rates at that same pace. So I mentioned the word stability, which is what lenders want to hear, what the financial markets want to hear, because it gives them confidence. It gives them certainty, if we're in a period of stability, to price their mortgages looking forward. Now, what does stability mean in my terms? Well, does it mean that rates will not move? No, I would not be surprised if the Bank of England still have to tinker and tweak the Bank of England rate. So if in the next 3 months we see the 5.25 going to 5.5, don't be shocked at that. But does it mean we're starting a new phase of increases? Highly unlikely. Excuse me. Notwithstanding, of course, Middle Eastern wars and things getting out of hand. And of course, we've still got the Russia-Ukraine thing in the background. So there's those things can always come out of left field to mess things up. But putting that to one side, then the Bank of England do feel now these things are now being managed, certainly in the UK economy, a lot better. And therefore, we're in this stability period. But there may well be some sort of tweaking. Over the next 18 months, I would expect the Bank of England rate to pretty much be around this marker, notwithstanding maybe a 0.25% adjustment up or down, just to get things right. Probably more up than down, because if inflation does stall a little bit, because it's at 6.7% now, it's still got quite a way to go to get down to the target of 2%. And therefore, if anything, we might see a slight tweak upwards if there's going to be an adjustment right now. I can't see inflation falling quicker than anticipated. So if anything, I can see a slight increase. And for the next 18 months, however, I see rates pretty much staying in the ballpark we're at right now. However, in 18 months' time, which is when the Bank of England expect inflation to be hurtling towards that 2% target, I can see them taking their foot off the gas. And that's where we'll start to see rates dropping. Now, will they go back to 1s and 2s? I've said before, those days are gone. Get rid of that notion in your head. However, dropping rates down to by 0.5 to 0.75% and maybe stabilising under 4.5 to 5% wouldn't surprise me, but we're not going to see that for a year and a half. Let's just look at this point at a chart that also highlights some of what I'm saying. Now, if you're watching on a laptop, you'll see this graph really clearly. If you're watching it on your phone, then maybe you're squinting at this point. So I'll do my best to describe what this chart is trying to tell us. And I just want to tease out a couple of points. But first of all, a bit of context. So this chart is set over a timeline of 2 years. September 21 on the left, across to November 23 on the right. And then on the vertical axis, we've got the actual interest rate from 0% up to 6%. And we've got 3 lines on it. The blue line is the Bank of England rate, and obviously it's gone from pretty much 0 on the left, looking like a mountainside, hitting that 5.25, and then it flatlines for those last 2 months on the right hand side of that chart. So we know that. The 2 other lines represent the average fixed rates over the last 2 years, and the red line is the average 2-year fixed rate, and the green line is the average 5-year fixed rate. And what I want to tease out, this is the thing. On the left-hand side, you'll see that the red line is below the green line, meaning the interest rate on average back in September, or certainly that last quarter of 2021, the 2-year fixed rate was lower, priced lower than a 5-year fixed rate. And that is normal. In my 25 years as a broker, that is what you would normally expect to see, because it's easier for banks, lenders, economists, the markets to predict what's going to happen in the next 2 years compared to 5 years. I mean, you'd say that about life. And it's no different in financial markets. Therefore, if they know what's going to happen in the next 2 years, they can price more keenly the products. Whereas once you're trying to price a 5-year deal, more uncertainty creeps in, more things can go wrong, and therefore they hedge their bets and inflate the rate to cover that potential risk accordingly. And that's normal. But follow that green and red line. You see where it crosses over. I swear, if I have to say this name one more time, I'm going to go mad here. It's like an unwanted relative turning up at Christmas. Here she is again, Liz Truss. This is going to be the last time. September, October 2022, you see that big peak there in the middle of the graph. That's where we went to hell in a handcart, where turmoil ensued. And that's also where the pricing turned on its head. And as you can see from that point onwards, the short-term deals were priced more expensive than the long-term. The red line is now above the green line. And if we follow that line right up to November 23, this chart is still telling us that on average, the short-term 2-year deals are still priced more expensively than the 5. Now, one thing I want to add to this as the broker who's at the sharp end of this is that I'm actually seeing more and more lenders almost on a daily, weekly basis starting to price their 2-year deals a bit cheaper. So I'm expecting this green and red line to narrow and narrow, and that red line, if I could show you this graph in 3 months' time, I would expect the red line to pretty much be crossing the green. Because, as I said earlier, we're in this period of stability, and that means that normal service should be resuming and the 2-year deal's getting cheaper. So right now, as landlords, you might feel that you're almost being forced to take a 5-year deal because they're a third, 0.5% cheaper than a 2-year fixed, even though you might prefer normally to take a 2-year deal. Well, expect that normality to return certainly by the start of the new year is my prediction. The last point I want to make on interest rates, and it backs up what I keep saying about stability, because the great news for us as brokers and of course landlords is that stability, what that means in real terms is that lenders are now reopening for business. They're chasing your business, which is why mortgage rates have actually been dropping, because they've got appetite to lend to you now. They feel confident that we've turned the corner, that we've gone from the previous phase of containing the problem to this stability phase. So I'm seeing now more innovative products coming out. And I also mentioned in last month's update that we will start to see relaxation of policy. And I want to give you one example today. TMW, the Mortgage Works, I believe they're the largest buy-to-let lender in the UK. Therefore, if they change something, if they relax policy, it's going to have a ripple effect across the majority of landlords. Now, TMW have had a rule in place for a number of years, specifically for those landlords with 10 properties or more. So when you want to submit an application to TMW, whether it be refinance or a purchase, they look at your background portfolio. And one of the things they look at is what the aggregate LTV of that background portfolio is. And they've always been really prudent of TMW and had a limit of 65%, that if your background portfolio went over 65%, they would decline your case, irrespective of how good a quality you are, etc., instant decline. And that bucked the trend because their competitors have pretty much always had a 75% LTV aggregate limit in the background. So great news that TMW have finally joined the party, lifted that restriction and pushed that 65% to 75%, which means as a broker, we can now look to TMW as well as the rest of the market for you larger landlords. And hopefully we can get, because normally TMW offers some pretty good, highly competitive products. So hopefully that's some really good news. And I'd be love to share more of that good news in following months with other lenders following suit. And finally, if you want to talk to the team about anything I've mentioned today, how does that impact you and your portfolio, or what you're looking to do in terms of making decisions for mortgages, book some time on with the team. There's no obligation. Book half an hour, have a good chat, and we'll give you some personalised feedback and advice as to what the best direction is.